my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat and London UK feed wheat. I'll start with Paris milling wheat. Right, the April to date based head and shoulders pattern was not as clear here as it was in Kansas City or even Minneapolis, but it was still there, and the break lower eroded the bearish incentive enough that the task of halting it was made easier by the 50% Fibonacci line for 2022 at 348 even. This hesitation carried on for just over a week before a further break lower. Now, please remember that hesitation, that it will become part of a bear flag later on. Anyway, prices carried on lower, reaching the primary target for the head and shoulders top. Then continuing lower, prices reached the target for the mid-May to June bear flag pattern, leaving just two targets below. Target X1 in the 299 area for the secondary and harder to get target of the original head and shoulders top pattern. Then there was target X3 in the 308 and 3/4 area. This was the target for the earlier mentioned bear flag pattern. I told you this level will come up again soon. Last week, after what had been an extended period of time, the market finally reached target X3, but it was a brief and clumsy affair, with the market reverting back up last Friday, and this week before making a combined outside day and bearish dark cloud cover pattern on Wednesday and dipping lower. Meanwhile, target X1 is still live and still out there. This brings me to what is the current situation. Well, I am not sure. By this I mean that it is obvious that the market has moved sideways to lower since July. That's obvious. The problem is that I cannot decipher just yet which of the two patterns the market is undertaking, or whether it is actually neither of them. The first pattern is a July to date triangle, come wedge pattern, currently 305 to 318. That is pointing lower enough to be considered a wedge, but not completely out of the triangle class. The issue of this pattern is that it has been breached on both sides, and both sides have been false breaks. Then there is the second pattern, the more recent late July to date bear channel, currently 298 to 328. Now this one looks good, but it's very recent and it needs more time and action to develop. I am not completely comfortable with that one either. Finally, there is the third option, of all this being something else completely, which it could very well be. You see, unlike the other grain markets that I've looked at, the declining short-medium moving average here, currently at 335, is almost paralleling the upper trend line of the shallowly bearish channel line and is actually paralleling the downtrend of the wedge come triangle pattern. What this means is there is currently no opportunity for the market to test this moving average or to be tested by it, unlike what we have seen elsewhere. Additionally, the dead cross we had here in late July had even less effect than in the other grain markets. Though I may side a little towards the bear channel idea, I really have doubts about all patterns currently available here. This one is going to require further thinking and market action to decipher. London UK feed wheat. Now, first off, please do not put any special store in the labeling of this chart being in red. It's my charting system, it's playing silly buggers, which it does from time to time, and this is the resultant effect. Anyway, that being said, the March to June head and shoulders top is still visible here, if a little disjointed. This was by no means a good head and shoulders top pattern, but it still worked. The primary target's already been achieved, but we still have a live, harder to reach secondary target X1 well down in the 217 even area. The more recent action is bearish, but is also not clear. By that I mean we have the possibility of one of two patterns under construction. You see, the mid-July to date action could be seen as either a shallowly bearish channel or a narrow but also shallowly descending broadening wedge pattern, both currently 249.80 to 272.40. Now, at the moment, I favour the bearish channel idea, but the wedge pattern is not as dead an idea as some might think. Interestingly, what is different here compared to the other grain markets is, well, it's manifold. For starters, the short medium moving average, currently at 267.05, is not only within the bear channel stroke lightly descending wedge pattern, but is actively engaged with the market, as recently as Wednesday this week, acting as resistance. On top of this, the long moving average, currently at 266.10, is also actively engaged with the market and has been since mid-July, initially as support and more recently moving to seemingly become resistance. This leads to a final point. We've not had any dead crosses here. None. Something that's been evident in the other grain markets. So the bearish pressure is still here, as you can see because of those moving averages. It just seems to be of a different form than some of the other markets. What that means for the future, I am not certain, but for the moment, the current bear channel come slowly descending wedge pattern, well, that is the one to watch. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.